well, we're not quite sure what to call this thing, and I guess we can't regulate it. But the SEC is not stupid. So now, if just naming something means, or just trying to label something one way so that you avoid regulation, um, happens, and everybody's going to go on this side of the fence, and the regulators will still come at it.
Yeah. So this is a much deeper conversation, and we apologize, guys, because we could dig into these for hours.
Right.
So we're going to have to kind of keep it somewhat surface to kind of get through this. But basically, what's happening is that there's two classifications, right? So they're saying one are securities and one are utility. And so from a security standpoint, it's more like a stock. And
right.
But the differences are that when I buy the coin of a company, of a blockchain company, and so anyway, before I say that, there's a coin, a token, whatever. They're really actually different. So a coin would be, you can use these words kind of back and forth, but technically speaking, a coin is more like a security, right, and a token is more like a utility. So there is a difference there.
Do you think they all know what you mean when you say utility, Mark?
Well, the utility, like you were saying, where it's actually used to process transactions on the network, and we'll get into that. First, let's just talk about the coin, which is like a security. So again, it's like a security, which is a stock, right? But the difference is when I buy a share of stock, I have a legal claim. I'm part owner of the company, and they have a fiduciary duty to me. When I buy a coin in a blockchain company, I have no such claim. I am no owner. I don't own a piece of anything, and they have no duty back to me.
That's right. That's right.
Now, maybe that will change in the future, but that's how it is today.
That's how it is today. And maybe it'd be helpful to explain what the SEC is and just very quickly, like 60 seconds, outline what their role is. You want to do that? You want me to do it?
No, you please.
Okay, so the SEC is short for the Securities and Exchange Commission. Their goal is simple. Okay, they are regulators of publicly traded stocks, among other things, but they regulate those firms that take their businesses to the public to raise capital, right? They share and own, they give an equity stake. Now, their primary purpose is to protect investors from all things bad in the financial space, right? You getting taken advantage of. They want to make sure that the markets operate efficiently and with order, and money doesn't start disappearing. And see, that's the fear of the SEC. Now, we can argue about how good the SEC is at what they do. That's a whole nother conversation me and Mark can certainly have. But their primary purpose is, think about how much capital, how much wealth is being created, Mark. I mean, you can talk about this 10 times better than I. How much wealth is being created from this crypto space? I mean, it's enormous.
Well, it's actually tiny. I mean, we're talking $500 billion versus 1 quadrillion in derivatives.
And well, yeah.
So it's barely even a drop on the bucket. But anyway.
Well, fair enough. Well, point taken. But what they want to make sure is that massive amounts of wealth don't just disappear from some side, oil snakes.
So the SEC was designed to protect people and make sure, kind of like the FDA watches over food, supposedly.
Don't go there, Mark.
Well, I would put them both in the same bucket. They're both for the same purpose. And we can have a whole nother conversation about how effective they are.
Right.
So the FDA was there to protect us from food, and yeah, I know. And the SEC was there to protect us from investments, and I would roll my eyes about the same. Now,
yeah, gotcha.
The one thing that I would say, and again, we can go way deep in this, and we're not, so I'll kind of leave it with this. But the SEC has basically came in and said, hey, we got to protect you guys, right? We're looking out for you. We're looking out for you. So you, the average person, cannot get into the best investments. So if I want to get into early stage companies, IPOs, ICOs, where all the money's made, the SEC says you have to be what's called an accredited investor. Right. That means you have to be able to prove that I think you have $1 million net worth, or you make at least $250,000 a year. If you can't prove that, the best investments, the one that returns the most money, you don't get a part of. Sorry, that's for the rich. The average person doesn't get that. Now, on the outside, it sounds bad, and I think it is. But here's the thing: I like to say I don't assign myself to a political party. I'm for more freedom and less government, whatever that means, okay? So the problem that I see with that is that people want the freedom, but they don't want the responsibility that comes with it. So that's the problem, right? Like you saw in this mortgage meltdown where you had millions of Americans saying, oh, I didn't understand the contract that I signed. I got tricked into signing for that mortgage. I mean, come on, really? You want the freedom to get that loan and buy that house, but you can't take the responsibility of reading what you signed? I mean, I can't buy that. But because those people then go to the government and bail us out, please, then the government has to step in and have to regulate it. It's unfortunate, right? So in this situation, in this situation, the SEC, they have to protect, because if people get in and lose their money, they're going to come cry to the government.
Exactly.
So it is what it is. I don't like it. I think it's actually ridiculous that you can go buy as many lottery tickets as you want. You can go spend as much money as you want gambling, but you can't get into a good investment. So I'll leave it at that. We can dive deep into that again. But anyway, that's what the SEC is. They're out there protecting us. It is what it is. Back to where we're at now. So a coin is like a security, what the SEC is saying now. It's like a security, but it's different because I have no legal claim and the company has no fiduciary duty back to me. And that is a big distinction between what a stock is and a coin is, right?
Yeah, right? No, I would agree. Yep.
And so I believe that the average person has more risk buying a coin than a stock, because that company has no duty back to me. So in a stock, there's no reason why that stock would go up, as we have established, unless someone wants to be paid more for it. But if that company is reckless with their funds and reckless with their company, there's legal repercussions there.
Exactly.
Whereas with the cryptocurrency blockchain company, if they're reckless, whatever, there's no legal ramifications. That's correct. There's no duty back to me. So that's correct. You got to be careful of that. All right. So we're establishing that. Now we can move on. The other one is what we call a utility token. And a good example of that, I like to use Ethereum, because everybody's heard of Ethereum. It's the #2 company out there, and maybe going to be the #1 pretty soon. We'll see about that. But I think the market cap's going to grow pretty fast. So anyway, what Ethereum is, just super quick, if you guys don't know, Bitcoin is money. Bitcoin is like, it's supposed to be like a currency. It's supposed to replace like the dollar, right? Ethereum is not. Ethereum is not a currency. It's not a money. It's not meant to be used in transactions. What Ethereum is a platform. So imagine you have your phone. I have an Android phone. And so I have an Android operating system on my phone. I have an app store that I can go into, and there's thousands of apps or applications. And those applications were designed to run on an Android system, operating system platform. And those apps have to pay to be on this platform and to use it, okay? And they pay in US dollars to Android or Google or whatever, right? Ethereum is essentially the same thing, but it's, instead of a phone platform, it's a blockchain platform, and they have applications being built on Ethereum. They're called dApps, decentralized applications. And those apps have to pay Ethereum to run on their platform, but they don't pay with dollars. They pay with Ether tokens. Right. So when you buy Ethereum, what you're actually buying is you're buying an Ether token. And so that Ether token has utility, because as of a year ago, 80% of all blockchain companies were built on Ethereum. They're all going to be paying to use the network, the transaction fees, and they're going to be paying in Ether tokens, which is Ether token. It's a utility token. So there's a reason for that token being, it's not meant to be a currency, and it's not speculative. And so, like, as we established with stocks, they're somewhat speculative, meaning there's really no mechanism for them to go up other than hopefully someone's going to pay more for them in the future. Right. And a coin is the same way, but with a utility token, it's not just hoping that someone's going to pay more for it in the future. There's actually a utility, kind of more like buying an asset that pay, like real estate, that would pay me something back. I mean, that's super simplistic view, right?
Yep, that's right.
Okay, so we've established the coin and the token. A token is used in utility. A coin is just something that I buy, kind of like a stock, but not really as good. So typically, I would want to stay away from a coin. I have no legal claim. There's no fiduciary duty, and there's nothing that would cause the price of that coin to go up. So as an investor, regardless of what I'm investing in, I always want to know, how am I going to get my money back? right? So I don't care if it's an oil field or a piece of real estate or a gold, whatever. Like, how am I going to get my money back? And anybody that's watched the Shark Tank, which is probably everybody, always sees that's like the first question, like Mr. Wonderful always asks, like, well, I don't see how I'm going to get my money back.
Yeah. Right.
So you should always ask that question. And for me, I'm not a gambler. I'm an investor. I don't bet on sports. I mean, I've been to Vegas a bunch of times, but like if I spend like $100, $200, like that's enough for me. I don't like gambling, but I invest a lot. But I look at it differently, right? So I don't want to just buy something hoping that someone's going to pay more for it in the future. To me, that just doesn't make sense to me. I want to know, how do I get my money back? Right. And so that's why I like the utility coins, because I can actually put an equation in there. Okay, so for example, with Ethereum, right now, if they add these many more apps and these apps go up in this much transaction fees, they're gonna this token is gonna be used this much more. So I could say this market is potentially 500 trillion size, and if they can capture 10% of that market, the transaction fees will go up to and I can run a calculation which will show me how the price of that token would rise.
Right.
Now, at the end of the day, it's a guess, right? I don't know if they can capture that much of the market. I don't know if the transaction fees, but at least it's better than just putting it on black.
Right. It's a guess based off of an actual product, an actual platform. It's actually, there's something there.
There's something there. And so like I can say, like, for example, Ethereum, as of now it's probably down maybe 60, 70% of all blockchain companies are built on Ethereum. I believe, so I'm going to back up just a second for those of you guys who don't know. Internet is a technology. The technology of the internet allows computers to upload and download data. That's it, information. I can upload information, you can download information. That's what internet technology does. Blockchain technology is different. Blockchain technology allows the transfer of real value, intellectual property, smart contracts, money. Right? So that's different. Obviously, a smart contract or an intellectual property is worth more than just raw information. So because of that, if you believe that, if you follow that, then an internet company that's only passing information, they're worth $500 billion today. Google, Facebook, right? All those. Amazon's almost $1 trillion. They're just passing information. I believe blockchain companies passing real value will be worth multiple times what an internet company is worth.
Right.
Okay? So I believe blockchain companies will be worth way more than internet companies will be, because it's real value as opposed to just basic information.
Right.
And so if you believe that, you follow that, 60 or 70% of all blockchain companies are built on the Ethereum platform. And we know platforms are always worth more than the applications that run on them. So think Amazon. There's brands that do hundreds of millions of dollars on Amazon, but Amazon's worth $1 trillion.
Right.
Right? So if we believe blockchain companies will be worth more than internet companies, which are worth $500 billion, and we know that 60 or 70% are built on Ethereum, and Ethereum will be worth more than those companies, it's going to be worth a lot of money.
Right. Where's Ethereum right now? Do you know where?
Today, it's worth 10% of Facebook. One US-based company is worth 10% of one company.
Wow.
If it can get to 20% of Facebook, it'll push Ethereum up to $2,000.
Yeah.
But I don't believe Ethereum is going to be worth 20% of Facebook. I don't believe Ethereum is going to be worth as much as Facebook. I think Ethereum is going to be worth more than all of those.
Understood. Yeah.
Crazy. But I can quantify that. I can put numbers and I can put data, and I can see why if Ethereum grows to 20% of Facebook, the coin's worth $2,000. Now I know why the price of that coin could go up. Okay.
Now, what do you think about regulation? I mean, so we started with this talk of regulation. What do you think? What impact do you think that will have?
So like I said, I don't want to be. I don't like talking politics. I don't even like politics. I like freedom. I like the right to choose what I want to do. So I don't typically believe that the government's the answer to anything. Like you said, we could talk about how good the FDA is. We can talk about how good the SEC
is, right?
So I would say on the outside, I don't really like it. However, I had to start with that. However, there's a lot of bad characters out there. There's a lot of bad actors. Somebody needs to regulate it. I believe in free markets, and I believe that given the right amount of time, the market can self-regulate itself.
Yeah. Mm-hmm.
But given the fact of where we are today, something needs to happen. And the SEC is up to the task of doing it. Again, we can talk about how well they're going to do.
Right.
But it needs to be regulated. I think at least in the short term, it's going to be good for the market. So we need it.
Yeah, I think it builds confidence, right? I mean, particularly given how sensational the media tends to be. I mean, I scanned the news this morning, of course, over the weekend, Friday. And what's the big story? Gosh, something, the loss is bigger than Mount Gox. What, help me out with that, Mark. Some cash, some wallet got.
Oh, no, she's talking about you're talking about NEM and the Japan.
Japan. Yes.
Yeah, $500 million.
$500 million, right?
Yeah.
So, I mean, people panic, right? People panic when they hear these stories and they're like, how safe is my money? How safe, what's happening in this space? So, I do believe that markets can regulate to some degree, but I think regulation is going to be important. It's coming. I don't think whether you care or not, it's coming.
It's coming. There's nothing you can do about it. And I would say that I believe regulation is a good thing. Now, is it self-regulation or is it SEC regulation? That's a different thing. But regulation is a good thing. So I will say that. But I want to get back into the coin and token thing. So we've established that a stock really has no mechanism. A dividend-paying stock might have a data mechanism for it to go up in value. Typical stock doesn't really. We've also established that a coin is very similar to that, where it really has no reason for it to go up in value, but it's even kind of worse because there's no fiduciary duty, there's no legal claim.
Right.
So really now we're looking at tokens, and tokens are utility, right? Like I used Ethereum as an example.
Mm-hmm.
Now what I want to talk about is that not all tokens, not all utility tokens are the same. Just because a token has utility doesn't mean it's going to go up in value. All right. So I used an example last night, and I'll talk through it again really quickly. There's a massive problem going on, and that's with tickets. Like if I want to go to a concert or a sporting event or whatever, and we have these scalpers with these automated programs, and they go in and they get all the tickets in advance, and then they're trying to scalp them on Craigslist and on these retailers, and that's a massive problem. And as a consumer, I don't know if I'm buying a counterfeit ticket. Is it fake? And then the ticket promoters hate it because their scalpers are ruining the market. It's a big problem. The blockchain is a new technology that's uniquely situated to solve that problem. They haven't been able to solve that problem in decades, but now this new technology, the blockchain, can solve that problem. So there's these new companies that are starting to use blockchain technology in this ticketing, and they're going to solve this problem. So what has to happen is the coin or token that they have is a utility token. I need that token to buy the ticket.
Right.
That's utility.
Right.
It's not a security. So I would think, okay, great. So this is going to be the largest ticket agency in the world, and we know that concerts and sporting events are the quadrillion, trillion, whatever market cap, and so if everybody uses this token, it's going to go up in value, right? So we would think that from the outside, but it's not really that simple. So basically, what would happen is we have, I'm sure Dr. Vegan knows, we talk about like the velocity of money, and velocity of money is how fast money moves. Now, typically in investing, velocity of money would be a good thing, because I would want $1 to be doing multiple jobs. Right. But in this situation, velocity is actually a bad thing. So we want to slow the money down. So in this example, I don't really want that token to buy the ticket. I want the ticket. Right. But I need the token. So I convert my dollar to the token. I only get as many tokens as I need. Right. I buy the ticket. So my money to the token to the ticket. Now the ticket agency gets the token, but they don't want the token either. Right. They want to go back to the dollar. They convert back to the dollar. Right. So dollar, token, ticket, token, dollar. It just goes right through. So that could be the most used token in the world. It could be It could be the highest volume token in the world, but that alone doesn't make the price of it go up. There's no scarcity. There's demand, but there's no supply issue. So we always know supply, demand, and Dr. V, you talked about last night, like buy low, sell high. It sounds super simple, but it's actually much more complex. And everyone's always heard supply, demand, but what does that really mean? So this is what it means, supply and demand. So the demand for the token could go through the roof, but unless we bring the scarcity down, the demand or the supply down, it doesn't have that supply demand effect. Right. So it's a pass-through vehicle. I mean, you're just going from the dollar back to the dollar and just boom, So. Yeah. So even though it's a utility token, because it's a pass-through, that's not enough to bring the price of that token up on its own.
Yeah, understood.
So what we want is we want to look for some sort of a mechanism that would cause the scarcity, the demand or the supply of that token to dry up. And so there's several ways that companies are doing this today. So one way is what we call staking. So right now with Bitcoin, I have to buy a computer. And you've heard of mining, right? So I buy a computer, I hook it to the blockchain. My computer helps process transactions, and I earn rewards for that. That's called proof of work, POW. That's called mining. What most new companies are going to now is what's called POS, or proof of stake. And that means that I buy tokens and I lock them up. I stake them. I stake my tokens. I lock them away. I take them out of circulation. And those tokens help process the transactions. And just like a computer miner would do and earn rewards, my stake tokens earn rewards. All right. And it's like a dividend. It's a dividend paying token.
I see.
It's a dividend. So I mean, if you could earn 3 to 5% in a stock dividend, that's pretty good. 3 to 5% is pretty good, right?
Yeah.
These are going to be paying usually between 5 to 10%.
Wow.
Dividends. So not only do I get the cryptocurrency and I get hopefully whatever appreciation that happens in the cryptocurrency, like my Ethereum is going to go from 1,000 to 5,000, but I'm also making a 5 to 10% dividend on top of that.
Right. Yeah, that's
great. And what that does is that causes me to want to lock up thousands of tokens and take them out of circulation to stake them. And now I'm sucking supply out of the market,
which will impact value, right?
So Ethereum is going to switch over this year from a POW, a proof of work, a miner. They're going to switch
POS?
to POS.
Okay.
And by staking tokens, I can help process transactions and earn dividends. Now, as I explained with the whole Facebook analogy, I believe that Ethereum is going to be worth $2,000, $5,000. So I can lock up my tokens, and they'll go from 1,000 to 2,000 or 5,000, which, by the way, isn't that good. And that's a 2 or 3x return, right? We're looking for 10x returns. So don't go jumping in. I'm not saying to go buy it, but I had to throw that out there. But hopefully my Ethereum could go from 1,000 to 2,000, 3,000, 5,000, whatever, and I'm earning 5 to 10%, but I'm taking them out of the circulation. So as these applications on Ethereum start to grow their business, they need to pay more in their transaction fees, but there's less and less tokens.
Right.
So the demand is going up as the supply is going down simultaneously. And that causes the price of the token to go up, theoretically, right?
Yep.
So again,
and this, so basically what you're talking about is the research that goes into what we do at Jarvis.
Yeah, and so obviously we do all this heavy lifting for you, but we're just trying to give you the framework so you can start to learn. Ultimately, we want to teach you guys, right? So that's what we're talking about. Now, that's one mechanism. Staking is a way to limit the supply to cause the value to go up. It's like anything, like a collector's item, right? Now, Bitcoin is in a unique situation where it's similar, although Bitcoin is not a utility token. The reason why Bitcoin has a supply and demand issue is there's only 21 million ever will be in existence. There's not that many in existence. I think it's like 16 million today. There will only ever be 21 million, but there really won't be. They estimate that probably anywhere from 6 to 10 million are gone forever. They've been lost on computers and whatever. Mm-hmm. So we'll probably end up with about 16. But even if we had 21 million, do you know how many millionaires there are just in the United States alone? There's 11 million millionaires in the United States. Just in the United States. That means there's not even enough Bitcoin for every millionaire to own 2. Now, I own a lot more than 2. So there's not even enough Bitcoin for every millionaire to own 2. So it's very scarce is my point.
Right.
And so I'm hodling, right? I'm hodling, you're hodling, we're all hanging on. Because it's become a store of value.
Yeah.
Bitcoin has become a store of value, and you can't really just set out to be a store of value. It just kind of happens, like gold is a store of value. So people are going into Bitcoin as a store of value, and I'm hodling, and I'm taking those out of circulation.
Right.
There's a very limited supply, and as these new hedge funds come in and these ETFs start coming in, the demand for Bitcoin is going to rise, but the demand is going to stay super low. So that's another way.
Supply.
That's another way that we can see the price of the token go up would be through store of value, which again, you can't really manufacture that. There's other ways that it's done. So what companies are doing now is they're burning tokens. And so they're getting rid of them. So when the transaction happens, the token gets burned up and disappears. Some companies are doing what's called a mint and burn. So as they're burning them, they're minting new ones. But what happens is, let's say they're minting only 50,000 a month. So as demand goes up, the burning will happen faster than the minting. So that's another way. Another way that we've seen some blockchain companies do this is with some sort of like gamification. A lot of companies are trying to like gamify things now, increases engagement and whatnot. So like, for example, there's like this influencer platform, and these influencers can talk about, whatever products they want, and they can get paid in these tokens. Now, what happens is when they hold those tokens, the more tokens they hold and the longer time they've held them for, they get pushed up in the rankings.
Okay.
So then they're going to get.
I haven't heard this one.
So they're going to get more reviews. More people will find them. More people review them, and now they're incentivized to hold the tokens for the longest period they can. Again, taking them out of circulation.
Right. So
that's what we're talking about. So I'm just trying to establish that a coin is like a stock. There's really no reason for it to go up in value other than the free market, the buyers and sellers studying that. A token would be more like a dividend paying stock where there's actually some data behind that where I could kind of see how that goes up. But a utility token alone is not enough. We want a utility token that has a scarcity mechanism built in. And I just kind of gave you like 4 or 5 examples of that.
Right.
So
that's awesome. That's awesome. I mean, I think what you basically underscore is the importance of understanding what the heck you're doing in this market, because there are a lot of coins out there. And we talked about this weekend, Mark, right? Making sure you don't buy on price alone. I'm going to buy it because it's cheap. I can't afford to buy one Bitcoin, so I'm going to buy because this is, $1 or $3. Yeah. There's a lot of game out there. If you don't know what you're doing, you get burned.
Yeah, for sure. And so, and it's your money, right? And like, right. I'm sure all you guys work really hard for your money. I've had to learn the hard way that, it's hard to make money, but it's even harder to keep money.
That's true. That's very true.
I had to learn the hard way. And so it's really easy to, start. It's easy to go buy any of these 1,400 companies, but are you going to keep your money or are you going to lose your money? And so, another thing I learned, I have a lot of these that I've learned. Unfortunately, I've learned a lot of very expensive lessons. But I learned that, the first rule to making money is to never lose money.
Absolutely.
And so the reason why I say that is that you need to understand these things so you don't get into these losing coins. I mean, 90% of them out there are losers. I'm not going to go out and say they're scams, but they're losers. Some are scams. But they're losers. There's nothing built in there that breeds confidence, and there's really even no mechanism in there for the value to go up other than what they call in investing the greater fool theory.
Right.
And the greater fool theory is that I have a theory that there's going to be a greater fool tomorrow to pay more for it.
That'll buy my coin.
And for me, that just doesn't cut it. Like that, no. I want to see data-driven numbers that would cause the value to go up. And nobody wins 100% of them. No investor in the world does that.
Right.
And so, even with the best tools and the best research, we're still not going to win 100% of them. But we're going to win more than we lose, and so we're going to make money. Especially because this market gives us asymmetric returns. So even if I were to put 10 positions open and one goes up 1,000%, the other 9 go to 0, I'm still making a ton of money.
Yeah.
Of course, we're going to win a lot more than 1 out of 10. But even using these best tools, we're still not going to win them all. But if you're just going out there and just, okay, on Twitter or YouTube, or this one said it was good, it's going to end badly for you.
Yeah. Agreed.
Yeah.
Wow. So,
hey, Charles.
Yeah, sorry, I had to step away for a second, but you guys definitely covered it. We are almost at the hour, so I think it's probably time to wrap up.
Okay.
Great conversation, because a lot of times, I hear people, oh my gosh, XYZ tokens gone up 300%. I got to go jump in, and
right.
People buy this stuff with no idea of what they're doing or anything on that side. So great that we dove into this. Thanks again, Mark, for hopping on. Thanks again, Dr. V, for hopping on too. And thanks for everyone else who's, tuning in and, we hope to talk to you guys soon. Alrighty.
Yeah.
All right, guys. Have a great day. See you
Okay.
tomorrow, Mark.
Alrighty. Bye-bye.
All right. Bye.